Welcome back to the deep dive.
Yeah.
You know I love a good IPO.
Oh, yeah.
And today we're diving into one that's got the construction world buzzing. Afcons Infrastructure.
Okay.
An Indian giant stepping onto the public stage.
All right.
You sent us their DRHP and RHP,
Yes.
which, for anyone unfamiliar,
Right.
are basically their pre-IPO financial reports.
Uh-huh.
And let me tell you,
Okay.
these documents are packed
Yeah.
with details.
It's like getting a backstage pass to their entire operation,
Exact.
seeing not just what they've built,
Yeah.
but how they've built it.
Yeah,
Financially speaking, of course.
of course.
These reports are essential for any potential investor
Right.
because they lay bare the company's ambitions, their
Mhm.
strengths,
Yeah.
and of course,
Yeah.
the risks involved.
It's like a blueprint for understanding where they are
Uh-huh.
and where they plan to go.
Exactly.
So
Sure.
let's start with their core business model.
All right.
What exactly does Afcons do? They're not your average construction company. Right.
They specialize in large-scale,
Oh.
complex infrastructure projects.
Oh.
Think bridges that seem to defy gravity,
Wow.
tunnels burrowing through mountains,
Oh.
and metros that redefine cityscapes.
Oh, okay.
They're not just building structures, they're
Right.
building the backbone of modern India and beyond.
And they're not just sticking to one type of project either.
Right.
Looking at their portfolio,
Yeah.
they've got their hands in everything.
They do.
From marine and port facilities,
Right.
which I find fascinating,
Yeah.
to transportation and water supply systems.
Yes. What's impressive is the sheer diversity of their project types.
I know.
This isn't a company betting everything on a single sector.
Right.
They're involved in roads, bridges,
Mm-hmm.
railways,
Right.
even offshore oil and gas platforms.
Wow.
This kind of diversification makes them less vulnerable to market fluctuations because they're not overly reliant on any one area.
It's like a portfolio approach to construction,
Yes.
which makes a lot of sense in a volatile world.
Yeah.
Okay.
Sure.
So they're building big things across a range of sectors.
Uh-huh.
But what about their geographic reach?
Okay.
Are they mainly focused on India,
Right.
or are they branching out internationally?
They've definitely got a strong domestic presence, but their ambitions extend far beyond India's borders.
Oh.
They've been strategically expanding their footprint,
Uh-huh.
particularly in Africa. Interesting. For
Yeah.
example, they completed the Tema to Mpakadon Railway in Ghana,
Okay.
which is the longest railway bridge in the entire country,
Wow.
and the first in Africa to use a specific type of foundation called raker piles.
Wow. The first in Africa.
Yeah.
That's not just building a bridge.
Right.
That's pushing engineering boundaries.
Exactly.
Speaking of impressive feats,
Okay.
their Chenab rail bridge project in India really caught my eye.
Uh-huh.
It's the world's tallest single-arch railway bridge. It is. And get this.
What's
It's
that?
designed to withstand blast loads.
Oh, that's right.
And that speaks volumes about their risk management capabilities and their commitment to building resilient infrastructure.
Yeah.
Remember,
Yeah.
these mega projects come with inherent challenges.
Of course.
Delays,
Yeah.
cost overruns,
Right.
regulatory hurdles,
Yeah.
and being able to anticipate and navigate those complexities is crucial in this industry.
Absolutely. It's not just about building something that looks impressive. It's about making sure it lasts
Yeah.
and functions as intended,
Uh-huh.
especially when you're talking about infrastructure that impacts so many people's lives.
Very true.
But let's move on to the financial side of things.
Okay.
Their revenue numbers jumped out at me.
Right.
They crossed $110 billion in fiscal 2022.
Wow.
That's...
Yeah.
Well, to put it in perspective,
Okay.
imagine a company raking in almost as much as insert well-known company or industry for comparison. And it's not just about the sheer size of their revenue.
Right.
It's about the trajectory.
Okay.
Their revenue has been climbing steadily, which suggests sustainable growth. Plus, their profitability is healthy,
Okay.
which is reflected in their decent return on equity, or ROE, and return on capital employed,
Okay.
or ROCE.
Okay, now I know we have some listeners who might not be finance experts.
Right.
So break down those acronyms for us.
Okay.
Why should we care about ROE and RCE?
All right.
What do they tell us about Afcons as a potential investment?
Think of ROE as a measure of how effectively Afcons is using the money invested by shareholders to generate profit.
Okay.
A higher ROE generally means they're making good use of those funds,
So a higher ROE, the better.
Exactly.
Got it.
ROCE broadens the scope,
Okay.
looking at how effectively they're using all their capital, including debt, to generate returns.
Got it.
So strong ROE and ROCE figures are usually a good sign for investors.
Okay. Because they indicate a company that is using its resources efficiently to drive profits and create value.
So they're making money.
Yeah.
They're using that money wisely. And they've got this massive scope of projects.
Right.
What's not to like?
Well, like any investment, there's always a flip side.
Of course.
While their debt levels seem manageable right now,
Okay.
with a total debt-to-equity ratio of 0.49 in fiscal 2023, which basically means for every rupee they've invested in the business, they only owe about half a rupee.
Okay.
Understanding how they manage that debt,
Right.
especially as they grow, is key.
That makes sense.
Yeah,
Taking on too much debt can be risky,
it can.
especially in a field as complex as construction.
For sure.
But let's talk more about the growth potential.
Okay.
One of the most exciting aspects of any IPO is trying to get a glimpse into a company's future. And Afcon's order book provides just that. It stands at a whopping euro 304 billion.
Wow.
Almost 3 times their FY 2023 revenue.
That's huge.
That's a pipeline packed with potential.
That's right.
That's incredible.
Their order book,
Yeah.
which represents the value of all their ongoing and upcoming projects,
Right.
is a strong indicator of their future earnings potential. And what's interesting is that a significant portion of their order book comes from government and government-owned clients.
Which tells us what exactly?
Well,
Is that a good thing, a bad thing,
yeah,
or something in between?
it's a bit of a double-edged sword.
Okay.
On the one hand, it suggests stability. Government contracts tend to be large-scale and relatively secure.
Right.
But on the other hand, it means Afcons is somewhat reliant on the government's spending priorities and policies.
So a change in government could potentially impact their pipeline,
It could.
which is something investors need to consider.
They do.
Okay, we've covered a lot of ground in this first part of our deep dive.
We have.
We've looked at Afcon's business model, their impressive project portfolio, and their robust financials.
Right.
But there's still so much to unpack.
Absolutely.
So much more.
In the next part, we'll dig even deeper into their financials.
Okay.
Exploring their profitability, debt management, and cash flow.
Right.
We'll also delve into their ambitious growth plans,
Okay.
the risks they face,
Right.
and what all of this means for you as a potential investor.
Looking forward to it.
Me too.
All right, let's roll up our sleeves and delve deeper into those financials.
Okay.
I'm always fascinated by how companies actually make money.
Yeah.
And Afcon's revenue streams caught my attention. They mainly earn through construction contracts.
Right.
But what's really interesting is their project diversity.
It's true. Their portfolio isn't just impressive in scale, but also in its breadth.
Yeah.
They've strategically positioned themselves across multiple sectors. Marine and port facilities, bridges, transportation, water supply, which acts as a buffer against fluctuations in any one market.
Right, so they're not putting all their eggs in one basket.
Exactly.
This multi-sector approach makes them more resilient.
Yes.
Now, digging into the numbers, their revenue has been steadily climbing, exceeding $110 billion in fiscal 2022.
Wow.
To give you a sense of scale,
Okay.
that's nearly as much as insert well-known company or industry for comparison.
And what's even more impressive is their profitability. Their return on equity, ROE, and return on capital employed, ROCE, are both healthy, which is a good sign for you as a potential investor.
Hold on. For those of us who don't speak fluent finance, can you break down what ROE and ROCE mean?
Sure.
And more importantly, why should we care about these metrics?
Of course. ROE basically tells you how much profit the company generates. For every rupee invested by shareholders. Imagine you invest 100, and for that 100, they generate 10 euros in profit. That's a 10% ROE. The higher the ROE, the better they are at using shareholder money to create profit.
So a high ROE means they're efficient at turning investment into profit.
Exactly. What about ROCE?
ROC.
It's similar, but it considers all the capital employed, including debt.
Right.
It gives you a broader picture of how efficiently the company uses all its resources to generate profit.
Okay.
A healthy ROCE, like Afcons has, indicates a strong ability to make money.
Okay, so a healthy ROE and ROC are good signs for potential investors.
Yes.
But even with strong revenue and profitability, debt can be a drag on any company.
It can?
What's the debt situation like for Afcons?
Their debt levels are moderate, with a total debt-to-equity ratio of 0.49 in fiscal 2023. This means that for every rupee they've invested in the business, they only owe about half a rupee.
That doesn't sound too bad.
Nope.
So they're not drowning in debt.
Not at all.
Okay.
Some debt can actually be healthy. It can be used to fuel growth and expansion.
Right.
The key is managing it responsibly.
Yeah.
And it seems like Afcons is doing just that.
Right. And they've even allocated a portion of the IPO proceeds to reduce their debt further. It shows they're committed to keeping their financials in check.
Yeah.
Speaking of future prospects,
okay,
let's talk about their order book.
Ah, yes. Their order book is like a sneak peek
into
their future earnings potential.
Right.
As of March 31st, 2024,
okay,
it stood at over euro 304 billion.
Wow.
Which is almost 3 times their FY 2023 revenue.
3 times?
Yes.
That's a lot of projects in the pipeline.
It is.
Signaling strong growth potential in the coming years. Wow, 3 times their current revenue. That's impressive.
It is.
Anything interesting about the types of projects in their order book?
Well,
are they sticking to their current sectors or branching out into new areas?
Well, something that stands out is the significant contribution from government and government-owned clients, which tells us they have strong relationships and the ability to secure large-scale, publicly funded projects.
So that reliance on government projects is a double-edged sword.
It is.
Stability, but also potential vulnerability to policy changes.
That's right.
But they're not solely reliant on the domestic market, right? They've been making moves internationally.
Absolutely.
Right.
While domestic projects still dominate their order book, overseas projects, particularly in Africa, are steadily increasing.
Okay.
This geographical diversification is smart.
Yeah.
It reduces their dependence on any single market and helps mitigate risk.
So they're financially sound.
They seem to be.
They've got a robust order book.
Yeah.
And they're diversifying geographically. Sounds like they're ticking a lot of boxes for potential investors.
A lot of them.
But every company has its challenges.
Of course.
What are some of the risks or potential downsides that investors should be aware of when it comes to Afcons?
Well, in the final part of our deep dive, we'll explore those potential challenges. From project delays and cost overruns, which are inherent risks in a construction industry, to the competitive landscape they face, and the potential impact of regulatory changes. Understanding these risks will give you a more complete picture before making any investment decisions.
All right, so we've explored Afcon's impressive track record.
Yeah.
Their robust financials. And that massive order book hinting at a bright future. But as with any investment, especially in an industry as complex as construction, there are always risks to consider.
Of course.
So let's shift gears a bit and talk about those potential challenges.
All right.
What are some of the red flags investors should be aware of?
Well, we touched on it earlier. But their reliance on government contracts is a key factor to consider. It can provide stability, but it also exposes them to potential shifts in government policies and priorities.
Like we said, it's a double-edged sword.
It is.
So a new administration could come in. And suddenly that massive highway project they were banking on is no longer a top priority.
Exactly.
Or new environmental regulations could emerge, adding unexpected costs and delays. It's something investors need to weigh carefully.
They do.
And then there are the inherent risks of the construction industry itself.
Yes.
These are complex, large-scale projects, often in challenging environments.
It's true.
Things can and often do go wrong.
Absolutely.
Delays and cost overruns are pretty common in construction.
Oh, yeah.
Think about it.
Okay.
You're dealing with unpredictable weather.
Right.
Potential material shortages, even unexpected geological conditions that can throw a wrench in the works.
Absolutely. And let's not forget the human element.
Oh, right. Yeah.
Labor disputes, contractor issues. All of these can impact project timelines and ultimately the bottom line.
So it's crucial for investors to understand how Afcons manages these risks.
Yes.
What systems they have in place to mitigate delays, control costs, and ensure quality.
They've got a pretty solid track record so far.
They do.
Completing projects on time and even ahead of schedule in some cases.
But past performance isn't always a guarantee of future results, right?
Right. And they're not operating in a vacuum. They're facing competition from other major players in the infrastructure space.
Right, of course.
The Indian construction market is particularly competitive.
Yeah, I bet.
With both established giants and new entrants vying for those lucrative government contracts.
So Afcons needs to stay ahead of the curve.
They do.
They need to be innovative, cost competitive, and maintain those strong client relationships to secure those contracts and keep growing.
Exactly. And that brings us to another important consideration, their growth strategy. They've been expanding internationally, particularly in Africa. Which is a smart move for diversification.
It is.
But expanding into new markets always comes with its own set of challenges and risks.
What are some of those?
Navigating different regulatory environments, cultural nuances, even logistical hurdles. It adds another layer of complexity.
So for investors, it's not just about looking at their financials and track record, but also evaluating their ability to execute on these ambitious growth plans.
Absolutely. Investing is all about weighing potential rewards against potential risks. Afcons clearly has a lot going for it. A strong portfolio, solid financials, and a robust order book.
I agree.
But understanding the challenges they face, from managing the complexities of construction projects to navigating a competitive landscape and expanding into new markets, is essential for making an informed investment decision.
So as we wrap up our deep dive
into
Afcons Infrastructure and their upcoming IPO, what are the key takeaways investors should keep in mind?
I think the main takeaway is that Afcons is a compelling player. In the Indian infrastructure boom, they've got a proven track record, strong financials, and ambitious growth plans. However, it's important to remember that every investment comes with risks. Investors should carefully consider Afcons' dependence on government projects, the inherent challenges of the construction industry, and the competitive landscape they face.
We've given you the information,
We have.
the insights, and hopefully a better understanding of what makes Afcons tick.
Hopefully.
Now it's up to you to do your own due diligence, weigh the risks and rewards, and make an informed decision that aligns with your investment goals.
Happy investing.
And that concludes our deep dive into Afcons Infrastructure.
Great.
We hope you found this episode insightful.
I did.
And as always, we encourage you to explore these topics further.
Definitely.
Remember, knowledge is power.
It is.
Especially when it comes to investing.
For sure.
Join us next time as we delve into another fascinating company.
Okay.
Making waves in the world of finance.